Basic accounting formulas. First, accounting equation. Accounting equation is the base of double accounting system where the asset is equal to liability and equity. So, in our question, the company owns the asset is of 1 million and there is a liability of 600,000. So, equity means asset minus liability is equal to equity. So asset 1 million minus 600,000 is equal to 400,000 is the equity. Now the second formula is the net profit. Net profit represents the revenue minus expenses. It shows how much a profit a company makes after deducting all costs. If a company makes a revenue of 100,000 and there's expenses of 40,000, it means the net income is 40,000. So this is the net income. Now coming to the gross profit. So gross profit is equal to revenue minus cost of goods sold. It shows profit after subtracting the cost of producing goods or cost of good sold. So there is a sales of 50,000 and cost of goods sold is 30,000. It means the gross profit is 20,000. 50,000 minus 30,000 is equal to 20,000. There is a formula or concept called EBIT. It means operating profit. So gross profit minus operating expenses. Gross profit from a regular business before interest and tax. Example, gross profit 20,000 and operating expenses is 5,000. So 20,000 minus 5,000 is equal to 15,000. Formula called working capital. Working capital is the difference between the current asset minus current liability. So current, it means it measures the short term liquidity. Positive working capital means a company can pay the short term debts. Current asset here 120,000, liability 80,000. It means 120 minus 80 is equal to 40,000 is the working capital. With the same working asset, current asset and current liability, we can calculate the current ratio. Current ratio is the ratio between the current asset and current liability. It shows that company pay current obligations ideally. In my example, the current asset is 120,000 and liability is 60,000. 120 minus 60,000 is equal to divided by 60,000 is equal to रखो ना. There is a acid ratio and that is called the quick ratio. Quick ratio means current asset minus inventory, current asset minus inventory. It means that easily convertible into cash against the current liability. So in my question, there is 120,000 is the total current asset. Out of 120,000, 40,000 is for inventory. So 120 minus 40,000, it means 80,000 is the quick asset against the liability of 60,000. It means 80,000 divided by 60,000, it is coming 1.33. Debt to equity ratio. So debt to equity ratio is equal to total liability divided by shareholders equity. It shows that how much debt is used compared to the owner's equity. So our question, 600,000 is the debts and 30,000 is the equity. So the ratio is 2:1. Now return on equity. It measures the profit against the 1 rupees of equity. In my example, 50,000 is the net income which the company earned against the 250,000 of equity. It's a 20%. Now, return on asset. It shows that how efficiently we have used our asset. Net income is 40,000 against the total asset of 400,000. It means we are currently earning 10% on return on asset. There is a concept called earning per share. It means how much profit is being earned by per share. So if a company has a 100,000 profit against the 20,000 of the shares, it means per share the earning is 5 dirham or 5 rupees. Now inventory turnover shows the cost of goods sold against the average inventory. So how many times inventory is sold in a particular period. So let's say 300,000 is the cost of goods sold against the 60,000 of the average inventory. So 300,000 divided by 60,000 is equal to 5 times is the inventory turnover. Account receivable turnover, it measures how quickly we are getting collected our money against the credit sale. So total credit sale divided by average AR. So total credit sales in my example is 500,000 and average AR is 100,000. It means that we are collecting enough. Our ratio is 5. We can use the collection period using the same formula against, say example, in a year 12 months. So 12 divided by 5. So we can say that in collecting our AR, it takes 2.4 months. It means we have to give on an average 70 to 72 days time frame or the credit period to our customer. The same, it is just a vice versa of AR turnover is AP turnover. Here we are paying. So total current purchase against the average AP or cost of goods sold divided by average AP. In my example, 400,000 is the total current period of cost of goods sold against the 80,000 of AP. It means the against the ratio is getting 5. It shows how fast we are paying our payment. The cash ratio is calculated against the current liability. The cash ratio is means cash plus cash equivalent. Most strict ratios using the cash only. So 50,000 cash and cash equivalent against the liability of 100,000. It means the 0.5 is the cash ratio. There is a operating margin. Operating income divided by revenue multiplied by 100 to present in a percentage. It shows what percentage of the sales is profit from the operation. It means 40,000 we are earning against the 200,000 of the revenue. It means if we are selling 200,000, we are just remained with the profit of 40,000. It means we are working at the 20% of the operating margin. Same way the net profit margin or net profit ratio. Overall profitability of the company in my example is 30,000 against the sale of 150,000. It means that we are currently earning 20% of the net profit margin. Book value per shares, the amount for the equity shareholder. It may equity shares plus reserve plus additional paid-in capital or share premium. If you add it together, divide by number of per shares. Okay, that is called the, in my example, the company has a net worth of 1 million against the 200,000 of equity, outstanding number of equities. It means there is a book per share is 5 dirham. Now price to earning ratio, PE ratio says that investor will willing to pay for 1 dirham of profit. So it shows it is a ratio against the market plus earning per share. It shows that how much time it will take to cover my price through the earning. So my example, say the market price is 100 and the EPS is 10. So it will take 10 years or 10 term or 10 period to get my money back from the as a market price. Dividend payout ratio, it means company is paying against the earning. May the earning 5 but company is paying only 2. It means the company is distributing only 40% of the share dividend. The rest 60% the company is retaining. Retention may be of any reason, maybe for the growth, for the reinvestment, for the new project. It's totally depend upon the companies and the management decision or shareholders agreement. So here are these are the 20 basic financial formulas which will help you to understand or analyze any financials. Okay, thank you very much.